Hello and welcome to Linear Talk, and my guest today is Theron from Eschler Asset Management. So welcome to the program. It's great to have you with us.
Thank you for having me.
Theron began his career in institutional equities with Goldman Sachs. He then ran an advisory business with an equity focus for Morgan Stanley before switching to become a buy-side analyst with Indus Capital, which was a hedge fund set up by a former Soros portfolio manager. So, great background. A number of our guests have an institutional background. Your background, how would you say that's been influenced the way that you've set up Eschler Asset Management?
Well, perhaps I'll start with a little background. As you said, I got started on the institutional sales desk at Goldman Sachs, and I was there for the 5 years, 95 ending in 2000 at the peak of the bubble. And
interesting times.
Indeed, it was a crazy sort of surreal time, and I was frankly immature and didn't have the context to understand what was happening. But you had the two-tier market where no price was too high for large cap and internet tech stocks. Meanwhile, old economy stocks couldn't find any bids.
Yep.
And I remember at the time reading an article in the Financial Analyst Journal called Cisco and the Kids,
yep,
which detailed very effectively the absurd valuations in the technology sector. So anyway, after the bubble burst in 2000, I caught the value bug, if I can put it that way.
Yes, as everybody got sober.
Exactly. Exactly. We come to our senses one by one. And I guess I made my first money investing with a value approach when I bought some shares in Philip Morris, which was a quality company trading at a single-digit PE. And my boss at the time ridiculed me for that, and it was a good contrarian signal. And a few years later, I discovered the Warren Buffett's chairman's letters and the books he recommended, like The Intelligent Investor by Benjamin Graham. And I knew at that time that I ultimately wanted to put these insights into practice, and I did a lot of reading during that time.
Yeah.
So that was how I spent that period. And then in the mid-2000s, as you said, I kind of combined my interest in investing and giving advice by running this sales team, advisory team at Morgan Stanley, which connected to a number of successful investors around the city. And that led to a buy-side role at Indus Capital. And I was at Indus Capital for the better part of 9 years, ending end of 2016, as an analyst and in business development.
Right. So the kind of analysis, this is hard graft stock, individual stock analysis, that kind of approach. So that's where you kind of got your grounding in what value really should be. So can you perhaps describe to us your investment philosophy and maybe how that differs from the way people would otherwise look at stocks?
Sure. So first, in investing, there's many ways to skin the cat, and each investor has to figure out what works best for them. What works for me is what Benjamin Graham first referred to as a business-like approach to investing. What does that mean? Well, it means viewing share prices as businesses, not as quotes on a screen or pieces of paper, and only purchasing those businesses when they trade at a large discount to what a sensible private buyer would pay. And the premise here is that the market occasionally gets emotional, and that provides the business-like investor with an opportunity to take advantage of this anomaly and purchase a bargain, and then patiently wait for the market to recognize the value. And this brings up an important point, and that is that the business-like investor views fluctuations in share prices as an opportunity, not a risk. And that's quite different than what many investors view risk as. They view risk as volatility, and they try to minimize it in various ways. A business-like investor looks at the market as as something that serves up bargains.
Yeah.
And provides the volatility in the market provides the foundation for the future return.
Yeah, it's a very different kind of mindset to many people. The real risk is a company goes out of business, and that's what you want to avoid. If you're constantly minimizing volatility, the chances are you haven't been paying attention to the real tail risk there, which is that you wake up one morning and they're Chapter 11. So.
Exactly, the permanent loss of capital that could occur.
And I guess, are there kind of specific kind of attributes that you look at that really matter to you, that might be beyond the usual type of valuation that people think, I think of PE, maybe price to book, and that's about it. But that's because I'm not an equity investor.
Sure. So, first of all, let me say, in terms of universe definition, I cast a pretty wide net when searching for investments. I come from a generalist background, so I look for out-of-favor industries, out-of-favor geographies. I use screens that fit my criteria. Perhaps most importantly, I talk with colleague analysts, investors, read annual reports, 10Qs, etc. I also look at different kinds of businesses at different stages of development. And I think the fact that I look at different industries, geographies, companies at different stages of development makes a concentrated portfolio more robust. Having said that, to specifically answer your question, there are 3 criteria that I nearly always look at. The first is simply a strong balance sheet.
Yep.
And one ratio that is admittedly a bit simplistic, but I think quite effective, is the equity to total assets ratio. And 50% equity to total assets ratio is a pretty high but appropriate hurdle for many businesses. Now, there are many businesses that have stable cash flows and can support higher leverage, but don't have much, if any, accounting assets. And so, other metrics might come into play. For example, net debt to operating income. But I think equity to assets is if anything, it cuts through the noise. It's not a hard cutoff for me, but quite useful. The second metric I would look at is return on invested capital. And so I'm looking for businesses that have a strong market position in a particular niche, and that often shows up in the return on invested capital.
I'm thinking about your Philip Morris trade of many years ago. It's a prime example of that.
Exactly. And why do I look at invested capital? Well, if you look at return on equity, that can often be massaged by the use of leverage. At the same time, I don't use return on assets because that will penalize a company for holding excess cash. And frankly, I think it's good to hold excess cash in many cases. So I'm looking for, I'm asking the question, can the company earn on the assets needed to run its business? So the working capital, net of cash, the plant and equipment. If the company's acquisitive, I include goodwill. And determining whether the return on invested capital is sustainable or not is more of a qualitative judgment.
Yeah, I was going to say that there are a lot of different ways one might interpret that as well, and it requires quite some subtlety, and the numbers don't necessarily speak for themselves unless you understand what the numbers are.
Exactly. So requires asking many questions. Has the high return attracted competition? Is the high return the result of a brand, for example, being overexploited in the market? Or is the high return the result of a permanent competitive advantage? For cyclical companies, is the high return representing a peak in profitability, or is the low return pointing to a trough?
Yeah.
For less established businesses, what is the normalized return that you can expect once the business reaches scale? And one last important point to ask is, to what extent does the business have the ability to reinvest incremental capital at high rates of return? So that's...
they're throwing off cash flow, but are they actually going to do anything with it?
Exactly.
The number of share buybacks we've seen since 2009, it's not all about that, but
Exactly.
it does beg the question, doesn't it?
Exactly. And the third and last thing I look at is, does the company have an owner-operator mentality, a management that has skin in the game? If a management owns a lot of stock, you can generally tell they're focused more on long-term incentives. They're issuing less stock options. They're talking, more about free cash flow and less about EBITDA.
Yeah.
They have an approach to buying back stock that's more opportunistic. So the idea is they want to increase the ownership of remaining investors, as opposed to just have an automatic buyback that offsets option dilution. And these managements also tend to be more astute at allocating capital, and this is very important for businesses that, for example, have a slowing growth rate or less investment opportunities. And there's a book actually that I would recommend that some of the viewers probably have already read called The Outsiders by William Thorndike, which chronicles several case studies of these managements that have this owner-operator trait.
It certainly makes sense because you're thinking about the business as a business as opposed to thinking about the stock price.
Exactly.
So you mentioned there cash flow. How important is that free cash flow? Many people talk about it, but is that a kind of key cornerstone of your kind of value investing approach?
I'm glad you bring that up, Colin, and the answer is yes. When I refer to the return part of return on invested capital, I'm not talking about EBITDA. A leveraged buyout investor who's in it for the short term and may not care so much about growing the business may use EBITDA. But for any business that wants to sustain itself over the long term, depreciation is a real expense. So I take it out. What I look at is operating income, so earnings before interest and taxes.
Which again is something that, not an equity analyst, I hadn't really thought about it, but it's such a powerful concept. If you think in those terms, you're thinking about the business rather than just another multiple that's plugged into your stock price.
Exactly. And EBIT includes depreciation, but excludes a number of the below-the-line items like how the company's financed, the leverage, the tax rate. If the company's acquisitive, they write off a lot of acquisition-related goodwill under IFRS. So
a key and important factor, I guess. Are there any other particular metrics? We've only got a couple of moments left that you would sort of say come kind of next on the agenda after looking at that important factor of cash flow?
Actually, I should just continue on that train of thought because, as I mentioned earlier, I look at cyclical companies as well.
Yeah.
And there's a metric in the gold mining industry called all-in sustaining capital. And basically, it's the all-in cost of producing an ounce of gold. And so it's not just the cash costs at the mine, but it includes accruals for sustaining capital, for reclamation costs when you close down the mine, for central office costs. And I think this is a very useful metric, and if people looked at it more, they would realize just how profitable the gold mining industry has become as we come out of this down cycle.
Commodity markets always have that tendency to, commodities fall in price in real terms because human ingenuity makes things easier to extract or yields of land greater. So it's a classic example, I think, to use, isn't it?
Yeah.
I'm afraid we've run out of time today. I'd love to talk some more about your strategies. Perhaps you'll join us again on another occasion, but it's been a real pleasure to have you on the program, and thank you once again.
Thank you, Colin. It would be my pleasure.